everyone. It's that time. It's 5:30, and we are here today at the SFCCU Credit Union Cooperative Society's Education Committee training session on understanding financial statements. We are expected to have with us today 19 participants, and of course, we are expecting that there would be others who may wish to join the session today. At this time, I want to take the opportunity to thank the members of the Education Committee, the chairperson, Mrs. Marcia Goodrich Constantine, and the other members of the Education Committee, the Secretary, Naomi Denny, and many of the other members of the committee who are instrumental in having this training session here today. But more importantly, the Education Committee has been able to collaborate with the Cipriani College of Labor and Cooperative. And um, as a result, we have this presentation here today um, with the compliments of the Cipriani College of Labor and Cooperative Studies. So we want to thank particularly Mr. Colin Bartholomew, who is instrumental in putting together the session here today on behalf of the college. So at this time, I want to welcome all the participants who are in the room, and we would want to begin at this time, and the other participants will come in as and when they do, they will fall into the sessions as we proceed. So today we want to look at understanding financial statements in the general sense, um, from a business perspective. And of course, as individuals, it is important that you understand how businesses treat with financial statements and how important financial statements are to businesses, and in terms of understanding where they are from a profit perspective and from a net worth perspective. So today, what we're going to look at, the key objectives of today's session, the key objectives are to assist participants in understanding the components which makes up the critical financial statements produced by a small business. And those financial statements are primarily the income statement, balance sheet, and cash flow statement. So those are the three primary statements that we'll be looking at today. Additionally, another objective of today's session is to ensure that participants can compute basic calculations on the income statement and balance sheet. And on this note, the planners for today's session would have forwarded via email some worksheets which we propose to use today. And we are also asking that you have with you your calculators, because we want to do some basic computations. In the end, when I would have assumed that you would have completed your computation, I'm going to present to you the answers to those calculations, and you will then be able to match the workings that you would have done, the answers that you have, to the answers that I have. Another objective of today's session will be to ensure that participants can conduct basic ratio analysis and interpret the results therefrom. Also, to consider the decisions which flow from the results of ratio analysis, because you see, it is one thing to calculate ratios, but it's another thing to understand what those ratios represent and what are the decisions that flows from those ratios. And finally, we are to understand the critical importance of notes to the financial statements. So let's look at this. We want to look at some definitions, basic definitions. Then we would look at the components of all three statements. What is ratio analysis and why is it important? Elements and formulas of the different ratios, calculating ratios, interpreting ratios, making decisions based on ratios, notes in financial statements, and finally, questions and answers. You're going to get the opportunity to ask your questions, and we hope to provide competent answers. So, let's go. Income statement or statement of financial performance. Now, we would have handed you, um, well, given you via email some worksheets. So at this time, I would ask you to turn to worksheet number 1 for you to understand the income statement. What is an income statement? What is that document that you have before you? That document in your email, the worksheet number 1. What is this? Well, basically, an income statement, also called a profit and loss account or profit and loss statement, is really a statement which shows the revenues and expenses of a business or a company for any given period within a given financial year. All right? So that is what this worksheet number 1 really is. It is an income statement or a profit and loss account or a profit and loss statement, which really shows revenues and expenses of the business for a given period in a given year. If you go to two, worksheet number 2 would be the same thing. Worksheet number 2 is one of those sheets that we'll be working with to compute the ratio analysis. So worksheet number 1 and worksheet number 2 are both income statements. Worksheet number 1 is blank, while worksheet number 2 is populated with figures for 2 years, and that's the period 2001 and 2002, if you look at worksheet number 2. And on worksheet number 2, you're going to find the revenues, you're going to find the cost, the operating cost of the business, and you're going to find the gross profit. You're going to find the operating expenses via the notes to the accounts, and you'll see the position before taxation and the position after taxation. So worksheet number 1 and worksheet number 2 are what we will call the income statement or the profit and loss account or a profit and loss statement. If we go to worksheet number 3, you will see that this is what we call a balance sheet or a statement of financial position. A balance sheet or a snapshot or a photograph is a statement which identifies a business or company's assets, liabilities, and capital position at any given point in time. All right, I want that to soak in. So your balance sheet really is like a photograph of the business position at any point in time. You take a snapshot of it or you take a photograph of it, right, at any given point in time, and it shows the value of the firm really. How much is this firm valued? And it seeks to lay out to the stakeholders. When I say stakeholders, I'm talking about the owners, the managers, the employees, the creditors, the debtors, your customers and your suppliers, and so They are the stakeholders of the business. So what the balance sheet seeks to do is it lays out at a moment in time what is the value of the firm, what is the value of the business, how much is this business really worth. And the balance sheet does this in comparative terms, meaning 1 year to another year, year on year. So we must look at it comparatively, comparing 1 year to another year. And that's what we mean when we say comparative terms, year on year. What happened in year one matched against what happened in year two. And when we do it in comparative terms, what it allows for us is really it allows us to examine the firm and determine whether the firm is improving or whether it is declining, whether the firm's performance is improving or whether the firm's performance is declining. And that is the importance of having 2 years in a set of financial statements for comparative purposes. So, so far, participants, we have covered 2 statements and 3 worksheets. So let's go over them again. We have completed the income statement, and that is worksheet number 1 and worksheet number 2. We have also completed the balance sheet, which is worksheet number 3. And in the balance sheet, you will find on worksheet number 2, you will also find year number 1, year number 2, that's 2001, 2002. And you will see on the balance sheet assets, liabilities, and something called shareholders' equity. Later on, you'll get to find out what that is. That's really the capital position of the firm, the owner's capital, right? What they put into the business. So we'll come to that a little later on. Good. So another statement that you have in your possession is worksheet number 4. And in worksheet number 4, we have something called a cash flow statement, or it is commonly known as a statement of cash flows. So what is this? What is your statement of cash flows as is laid out to you in worksheet number 4? Well, a statement of cash flows is really a statement which shows how cash was used in the firm during a particular period. It is essentially concerned with the flow of cash in and out of the firm. So, while the income statement deals with the profit or loss of the business, and the balance sheet deals with the value or the worth of the firm, the cash flow statement, which is the third of the 3 set of statements we'll be working with this evening or this afternoon into evening, the cash flow statement really deals with the cash position of the firm. In essence, what we're saying is a firm could be profitable, but it may not have cash, or it may have a cash flow problem. And a case in point is Clico Financial. I don't know if how many of you remember the position of Clico, but Clico was in a good position as it relates to assets. They had a lot of assets on the books, but the problem that they had was a working capital problem where the cash was a problem, liquidity. And so firms must be careful. Firms must be careful that they manage their cash flows properly so that while the firm may be profitable, it must also be liquid. And that is what that's how important the cash flow statement is. The cash flow statement helps you to determine how liquid the firm is, whether the firm has cash or whether it has no cash. And finally, this evening, I want to bring to your attention what are notes to the financial statements. Well, if you go to your worksheet number 5 and worksheet number 6 and worksheet number 7, those three worksheets are what we would consider notes to the financial statements. So worksheet 5, 6, and 7 are what we call notes to the financial statements. What are these? Well, these are the additional information which are provided by those preparing the statements to those reading the statements. So it's really like a communication tool. So those preparing the statement will communicate to those reading the statement about certain things. What are those things? Well, the communication that takes place between those two players are really pertaining to the firm's operations and financial position and are considered to be an integral part of the financial statements. So while we may have the income statement and we have the balance sheets and we have the cash flow statement, the notes to the accounts, the notes to the financial statements are also critical because there are some things in the financial statements, in the income statement and the balance sheet and the cash flow that you may not understand or that you may need further clarification on. That is where the notes to the accounts will come in. And so the notes to the accounts are important because they help to elucidate or shed light in dark areas that may be found in the income statement and the balance sheet. So now we move on to the components of each of those statements. So I hope at this point, as we settle down, and I know that we have a few more participants joining the session, and we want to welcome you as you come in. Essentially, where we are here now is we are now going in to drill down into each of those statements. So we said there's the income statement, the balance sheet, and the cash flow statements with notes to the account. So we're going now into each of those statements so that you could understand. Remember, today's workshop is really understanding financial statements. So you can't understand financial statements if we don't drill down into them. And that is what we're going to do now. So let's begin with the income statement. First of all, if you turn to worksheet number 2, either 1 or 2 will work, but we would particularly spend some time on worksheet number 2. So on worksheet number 2, we have something called revenue. So what is revenue from worksheet number 2? Well, revenue, also called income, also called sales, and these terms are used interchangeably. And they are found in something on this statement that we call, that part of the statement, we call it the trading income. What do we mean by that? Well, this type of income is principally related to the trade of the business. So in terms of a credit union, trade income would really be income from interest on members' loans because that directly relates to the trade or to the core business of the institution. So in terms of a credit union, trading income or revenues or sales really relates to interest from members' loans or interest on members' loans. That's trading income. If you were to do, let's say, you were into another example, maybe a supermarket. So let's assume a supermarket that sells groceries. Trading income for a supermarket would be revenue from the sale of supermarket items. But if at the same time that supermarket has they decide to sell a motor vehicle, the supermarket is not involved in the sale of motor vehicles. And therefore, if a motor vehicle that the supermarket would have bought probably for a manager or a supervisor or somebody, and they decide to sell that motor vehicle, the receipt from the sale of that motor vehicle is not trading income. The receipt from the sale of that motor vehicle is what we will call the next one other income. So, other income is income other than trading income. So, for example, you may get dividends based on some investment that you have as a business. When you get that dividend, that is not trading income, that's other income. All right? So, I hope I would have made that abundantly clear in terms of making the distinction between revenue, income, sales, which is really trading income, and other income, which is income that you derive from other sources other than trading income. So the next item, if we stick with worksheet number 2, you will see something, heading big and bold there called cost of sales. Well, cost of sales or cost of goods sold is really the principal trading cost which were incurred in making the sale or in creating the income. In a sense, this is really your operating cost. What do I mean by that? Well, well, if you are going to, let's assume that you're into and we'll come back to the credit union in a little bit. But let's say you're involved in manufacturing. The cost you incur in buying raw materials, in paying for wages and wages principally for those workers who work in the factory, all of those costs, materials and labor, are considered your operating costs. They are considered variable costs. Those are the costs that you incur in order to bring the product to the point of a sale. So cost of goods sold or cost of sales are really those costs, those trading costs, principally related to making the good or creating the income or making the sale. All right? So if you look at worksheet number 2, you would see under cost of sales, you will see something called opening inventory. So that would have been opening inventory is basically those goods that would have been bought last year that remained at the end of the year and has now come into this current year. So that is what we call opening inventory. So opening inventory is closing inventory from the previous year. And then we have delivery. That this is really transportation costs to bring the goods from the port or to bring the goods from wherever, from the supplier, whoever, the manufacturer, whoever is producing the goods for your business. The delivery cost, the transportation cost is a cost of sales. And then we have purchases, which really are those goods that we buy during the current period. So essentially what you will have is that you will have goods that came forward from the year before that will now be sold in the current year, plus the goods that you bought in the current year. And then you will now have to take away from all of that above there on worksheet number 2 on the cost of sales. You'll now have to deduct from that the closing inventory, meaning those inventory that remain in stock at the close of the year that were not sold. And your closing inventory in one year becomes the opening inventory in another year. All right? So that's your cost of sales. Let's go quickly to expenses because time is against us. So let's go quickly to expenses. What are expenses and why are expenses different from cost of sales? Well, essentially, expenses are really non-operating cost, meaning you must separate your operating costs, which are really those costs that are incurred to bring the goods to market or to get the goods to the point where those goods can be sold. And then you have those non-operating goods, which are really your overheads, your expenses like rent and telephone cost and, the supervisor salary, because whether the supervisor work or they ain't work, they're on that monthly kind of salary arrangement. So they really not tied to operating cost. So they are administrative in nature. They are called overheads. So whether you produce one item or you produce none at all, those costs are still relevant. You must incur those costs. So for example, let's assume that you're manufacturing light bulbs in a room, but you have to pay $5,000 rent for that room. The question is, if you produce one light bulb in the month, will you still have to pay rent? The answer to that question is yes. What if you produce 10,000 light bulbs in that same month? Will the rent change for that room? The answer to that is no. The rent will remain the same $5,000 whether you produce one light bulb or whether you produce 10,000 light bulbs. So expenses are really those non-operating cost items, which really are incurred and are considered as overheads. They are fixed in nature. They're fixed costs, unlike the cost of sales, which are really variable costs. They vary with the level of production. Whether you produce one light bulbs, if you produce one light bulb, you will incur a lower cost of sales, as opposed to if you produce 10,000 light bulbs, you will incur a higher cost of sales. So your cost will vary based on the amount of light bulbs that you produce. That's the issue with cost of sales, unlike expenses, which are fixed. So whether you produce one or you produce 10,000, your overheads are not going to change. So we have completed your understanding of income statement, and I hope that at this stage you would have grasped in some basic form what is an income statement and what are the elements of an income statement. We will, of course, entertain all your questions and comments and so when we come to the end of the presentation. And those questions and comments will be facilitated by the Cipriani Labor College on this. So let's move now to the elements of or the components of the balance sheet. And as we said, that is worksheet number 3 that you would have in your possession. So what are the components of the balance sheet? What are those components? Well, the balance sheet is made up of assets. What are assets? Well, assets are owned by the business, and assets are those things that are used in the business to generate profits. So let me make this point. Let's assume you buy let's assume you're a sole trader, and your nature, the nature of your operation is such that you buy and sell plants. And in the buying and selling of plants, of course you need a stall to put your plants on. So that stall will be considered an asset. Why? Because the stall will be used in the business to assist in the trade, and the stool will be used to generate profits. But let's assume in that same small business that you have, you as the owner decide you want to buy a BMW for yourself. The question I want to ask you participants is this: will the BMW motor vehicle that the sole trader bought be considered an asset? Well, I could hear resoundingly many of you are saying yes. Well, I want to put it to you that the answer is wrong. The answer is no. That BMW that sole trader decided to buy for themselves, they are really, that is a luxury item that they are using personally. And that is not considered an asset because it will not be used in the business to generate profits for the business. No. However, if that plant store owner decides to buy a panel van to transport the flowers and plants and pots and so, that panel van will be considered an asset because the panel van will be used by the business, it will be used in the business, and it will be used to generate profits. So that's an asset. And don't ever forget that today, okay? Those are assets. Let's go to liabilities. What are liabilities? Well, essentially liabilities are owed by the business resulting from a past transaction results in a transfer of economic benefits from the business to a third party. What does all this fancy language really means? Well, let me break it down for you. For something to be considered a liability, it must first be owed by the business. Meaning, if the business doesn't owe that sum, then it is not considered a liability of the business. So the business must first owe that amount. Then, that amount that the business owes must result from a past transaction, meaning the business probably would have bought some goods on credit and they haven't paid for it, and therefore the cost of those goods are considered a liability. All right? So it must result from a past transaction of the business. And the final test that something is a liability to a business, the final test is that it must result in the transfer of economic benefits from the business to a third party. So essentially what we're saying here is that you cannot have an amount on your balance sheet and call it a liability year after year after year after year, but you're not paying it at all. So it's not resulting in you taking money from the business and paying off somebody down the road sometime into the future. That is not a liability. It must be removed from the books. You cannot put it on the books if you don't intend to pay it sometime in the future. It must result in a transfer of economic benefits from the business to a third party. So which means the business must spend some money to pay that liability sometime in the future. And if it remains there on the books year after year after year, then it is not a liability or is not considered a liability. Right? So in worksheet number 3, we have liabilities either current or long term, and that's an important term for when we go further. Right? So worksheet number 3, liabilities are current, and under current we have bank overdraft, bank loans, accounts payable and accrued liabilities, long-term debt, current portion, and income tax payable and so forth. All right? Good. And then we go now to capital. What is capital? The third element of the balance sheet. What is capital, or sometimes called equity? Well, capital or equity is really the injections into the business by its owners. No guaranteed return in the end. It is risky business, participants. It is risky business. When you decide to take money, whether to take a loan, whether to get a loan from a financial institution or from a family member, wherever you take the loan from, if you take a loan in order to start a business, it's risky business because there are no guarantees that your business is going to do well. There are no guarantees that your business is going to turn a profit. So therefore, the injection of capital or equity into a business is risky business. But in life, there are risks that one must take. All right, let's move quickly to cash flow statements. Well, if you go to worksheet number four is our cash flow statement. And there are three important headings I want you to note. Look at the three headings. One of the headings is called cash flows from operating activities. The other heading is called cash flows from investing activities. And the third and final heading is called cash flows from financing activities. So it is important when we look at a cash flow statement that these three headings are in the statement. So let's go quickly to the first one, operating activities. Operating activities really focus on reconciling the profit from the income statement as we know it back to actual cash used or received in the business. So essentially, what operating activity seeks to do is to remove the non-cash items and it is really looking at working capital items and their movements, meaning those items that are principally related to current assets and current liabilities, working capital, current assets, current liabilities, right? So operating activities reconcile your profit in the income statement back to the cash used or received in the business. What the cash flow really interested in is what cash was used. We are interested in the non-cash items from the income statement. The second heading on the cash flow statement is called investing activities. Now, investing activities look at the way the firm invests its funds and the resulting returns flowing therefrom. So essentially what we mean is this. When the firm decides that it wants to take cash and invest those cash in some investment outside of the firm, then investing activities under that heading wants to look at the flow, the inflow and outflow of funds from that investment, meaning the cash we put out to invest and the returns or the dividend, the what we call the interest income that we receive, the returns on those investments. That is what the inflow really looks at under this heading. And finally, the third heading under the cash flow statement really looks at your financing activities. What are these? Well, financing activities looks at the borrowing of the firm, whether the firm took a loan and the proceeds from that loan and how the loan is being serviced, whether the firm is paying back those loans. So the monies that are coming in from the loan, the borrowings, the proceeds, and the money that are going out, the cash that is going out from the firm to pay back that loan. So it indicates the level of borrowing and repayments along with new sources of financing the firm. So maybe under this heading, let's assume that a family member of yours decided that they want to invest in your business and they decide, let's say they want to give you $10,000 to invest in your business. That will fall under this heading. That's money coming into the firm. That's cash coming into the firm. And that's new investments in that way. It's like a loan you're getting from your family member. Good. So we have come to the end of the explanation with regards to the elements of each of the three statements. And so we go now to get you to do some work. We want you to do some work. This is an action-oriented training. So you can't come to the training and just sit down and listen. We want you to make sure that you have your pen or pencil, as the case might be, ensure that you have some scrap paper close by, or a notebook, or a notepad, or something to write. And make sure you have your calculator. You see, I have my calculator and pen on the screen. So have your calculator and your pen ready, please. So we're going into some computations now for you to understand what really causes a firm to tick. What are the things that you look for? What are the things that will determine whether the firm is doing well or doing poorly? So, what is ratio analysis and why is it important? Well, ratio analysis is a tool used to analyze a company's financial performance over a given period of time, comparatively speaking. Again, you see the word comparatively coming up again. So earlier we talked about comparatively really meaning year on year, 2 years to compare. So you compare the base year and you look at the other year, the current year. Right. So ratio analysis is important so as to allow the firm to examine its risk and to take steps to mitigate those risks. Because firms are exposed to risk, and we spoke about it earlier when we mentioned that if you invest in your business, it's risky business. So as you invest over time, you need to examine your risk to determine whether those risks are too high for you to continue into business, whether the business will continue as a going concern, and what are some of the things that you need to take into account to mitigate those risks. So, what are some of the risks involved in businesses? Well, there's something called business risk. It's really a solvency risk, really meaning whether the business will continue in existence for the foreseeable future. That's really what business risk really means. It's solvency, whether this business will shut down in 12 months' time or less, or it will continue into existence for the foreseeable future. The next type of risk that you have in businesses is what we call liquidity risk. Liquidity risk is really that cash flow that I was talking about earlier, that cash flow issue. And I spoke about Clico having this problem. They had a liquidity problem. And therefore, when you analyzed, or if you were analyzing Clico's books prior to their demise, you had engaged, if you had come to my class earlier and you had learned about ratio analysis, you could have done some ratio analysis on Clico's books, and you would have been able to go to Clico's management and say to them, listen, your company is experiencing liquidity risk, and they would have taken steps to mitigate that problem. But obviously, the high-ranking officials at Clico at the time failed to recognize the liquidity risk that the organization faced. So you have liquidity risk, and then you have this issue of profitability risk. What a profitability risk? Well, that's the risk that the business will not be profitable. So there are risks involved, and they are called profitability risk. What about growth risk? Now, this is a significant risk. Now, a business could continue in existence for the foreseeable future, but not grow at all, remain stagnant. So that business has a growth risk. And finally, there's this issue of efficiency risk. And efficiency risk really speaks to how efficient is the organization as it relates to the collection of cash, the payment of bills, the time value of money, how does the firm get a good bang for its buck? So, do you have staff who are not pulling their weight and they're not efficient, and the staff have to do over, or they have to do over a task more than once, and so they become inefficient. So you have that efficiency risk that you have to monitor. So, elements and formulas of the different ratios. There are 5 main categories of ratios that we're going to treat with this evening, and we want to get cracking now. One of them is called the profitability and return ratio, the long-term solvency and stability ratio, the short-term solvency and stability ratio, and the shareholders return ratio, and finally the efficiency ratio. So get your calculators ready, your pen and your paper. Let's go. So at this time, I want you to go to handout worksheet number 2, please. Go with me to worksheet number 2. And remember, you will be matching your answers back to my answers in the end. So let's see if you have learned anything in what we have done here today. So let's go. The first ratio I want you to work out with your scrap paper, your pen and scrap paper and your calculator. I want you to work out your profitability and return ratios. For example, could you first do your gross profit margin for me? That's the first ratio I want you to work out, the gross profit margin. So what you're doing is you're looking at worksheet number 2. You're taking the gross profit for 2001, which is what? The gross profit for 2001 is 348,765. Work with me now. Quickly, quickly. Let's go. The gross profit for 2001 is 348,765. You're taking that figure and you're dividing it by the revenue. And the revenue here for 2001 is 1,133,736. And then when you get that result, you multiply it by 100, right? And that will give you a percentage, okay? Are we clear? I hope that we are working. Please, no skyline out here. Get cracking. Come now. Right. Let's go to year number 2. The gross profit is 364,672, and you're dividing that gross profit over the revenue of 1,104,786, and the result you get there you multiply by 100, and that will give you 100. That will give you a percentage. All right. So let's see if you're efficient, and let's see if your answer is correct in the end. We'll be matching those answers. Okay. The next ratio I want you to work out quickly for me is what we call your net profit margin. The net profit margin. And on worksheet number 2, we still on worksheet number 2, I want you to go and take for me your income, your net income before tax. No, I want you to, no, you know what? Let's use the net income after tax. And that would be in 2001, that will be $8,810. And you're going to divide that over your revenue of 1,133,736. And you're going to multiply the results by 100. And that should give you a percentage, okay? And then for 2002, I want you to take your net income after tax, which is 78,516. And I want you to divide that over the revenue figure of 1,104,786. And of course, get your results there, multiply by 100. Right. And finally, under this, I want you to take now, we're going to work out your return on total assets. And please work with me now, quickly. Don't be lazy now. Let's go quickly. So let's go. Return on total assets. So your return on total assets, really look at your earnings before interest and tax. So we will be looking at your net income before tax. And you're dividing that over your total assets. So where do you find your total assets? If you go to handout number 3, worksheet number 3, you will go to worksheet number 3 and you will see a total assets there. So let's go now. Earnings before interest and tax for 2001, the figure will be, again, $8,810 divided by, in 2001, your total assets were 331,259. That's a figure. 331,259. So that's the first computation, and you're multiplying that, whatever result you get, by 100. And then in 2002, you're going to your net income before tax, which would be 92,903. So 92,903. And you're dividing that over your total assets for 2002, which is 276,498. And whatever results you get, you multiply by 100. So if you have done that, then we are halfway there. So essentially, once you do those calculations, these are the things you have already determined. One, you have determined the profitability of the business, and you have determined how well assets are used to create wealth for that business. Let me go again. What does those results, those computations you have just done, what do they mean? Well, they indicate the profitability of the business, and they also indicate how well assets are used to create wealth for the business. And what I want you to do in your comparison is look at year on year. And when you look at year on year, you will tell me whether the business is improving or whether it is declining. So that's important. All right? That's important. So let's continue. So I know we have some bright students in this class. I can name a few, but I wouldn't at this time. So we have some brilliant students here who I am sure have completed those already. So let's go on quickly now to the long-term solvency and stability formulas. So the elements and formulas for the different ratios. We're looking now at debt to equity ratio. Let's quickly go to this one. So those of you who are sharp, let's go. Debt to equity ratio, you're taking your total debt and you're dividing that total debt over your total equity. And the results you will multiply by 100. Okay? So let's go. In this case, you're going to handout number 3, which is your balance sheet. And you're going to year number 2001, right? So the year 2001. And your total debt will be 392. That will be your total debt for 2001. 392,608. That's your total debt. And you will be dividing that over a negative figure. And I know some of you are going to tell me, well, how is that even possible? I can't get a negative. Well, let's see. So you're taking 392,608 and you're dividing that over your total equity. And your total equity in 2001 was a negative figure. It was negative 61,349. So that is the figure in 2001, okay? Year 1. Let's go to year 2. In year 2, you want to work out your total debt again, your debt to equity ratio. You're looking at total debt. So your total debt would be, in 2002, it would be 259,331. So 2002 total debt, 259,331, and you're dividing that over your total equity. And in this case, your total equity is 17,167. 17,167. Now, people, you have to hurry up now because our time is limited. We only have about 45 minutes again, or maybe less than that. So let's push quickly. You have a lot to cover. All right? So whatever you work out there in year 1 and year 2, that would be your debt to equity ratio. And you need to look at the comparative between both years. Let's move quickly now to our debt ratio. Your debt ratio is your total long-term liabilities. Huh? Notice the difference between total debt to long-term liabilities, which mean of your total debt, all we picking out from it to get your debt ratio is the total long-term liability. And then you will divide that over your total assets. So let's go now. We're still on worksheet number 3, and we're going now to take your long-term liability. And in 2001, your long-term liability would be due to shareholder. Now, if you don't believe me, let's go. Go to note 3. You see it says there next to due to shareholder. Note 3 says what? Let's go quickly to note 3. And note 3 is found on worksheet number 7. Go to worksheet number 7, note 3. And that heading says due to shareholder. And let's read what it says there. The amount due to the shareholder bears interest at a rate determined annually and has no fixed terms of repayment. Now, that's a very important statement to make. See that statement that says, and has no fixed term of repayment? Well, that says to you it's long term. Now, if it had said that it has to be repaid in 12 months, then it would have been short term. But because it says it has no fixed term of repayment, that means it's long term. So let's go back now to worksheet number 3. And we are going to pick up for 2001, we're going to pick up the due to shareholders figure, which is 231,791. So in 2001, it's 231,791 divided by your total assets. And if you go up the page, remember your total assets is 331,259. And then the results you get there, you multiply by 100, of course. Let's go now quickly to 2002. In 2002, your total, I'll have to use my calculator now, your total long-term liability would be 51,591 plus 86,100. So in 2002, your total long-term liability would be 137,691. And you'll be taking that figure and you'll be dividing it over your total assets in that year. And the total assets in that year is 276,498. 276,498. Good. So I know that you all are very studious and everybody done worked this out already. Very good. So the final thing under this section we want to look at is interest cover. Earnings before interest and tax divided by your total interest. Let's go back to worksheet number 2, please. Go back to worksheet number 2 quickly. And under worksheet number 2, I can hear the papers turning. Very good, very good. It means that we are all into the thing. We're participating. We're using our calculators. So we're all active. Very good. So earnings before interest and tax in 2001, we used that figure earlier, is $8,810 in 2001. And you're dividing that over your total interest. Where would you find your total interest? Well, go with me to worksheet number 5. Worksheet number 5. And I want you to go through the list of operating expenses you see there. And I want you to go with me to interest on long-term debt. You see that figure? Interest on long-term debt. So the interest on long-term debt in 2001 was 0. So therefore, For the figure for 2001, you really have nothing to cover. There was no interest to cover there because you had no debt, no long-term debt in a sense there. So there is nothing. So that figure, no, there's no interest covered there in that year. But let's go to 2002. The earnings before interest and tax in 2002 on worksheet number 2 would be what? We used that figure earlier. It would be 92,903. So 92,903 must be divided over, go back to worksheet number 5 and go to the list of operating expenses and go across interest and long-term debt. And the figure here is, I'm almost hearing you, you know, $11,876. So what you're going to do is you're dividing on the 2002, 92,903 divided by 11,876. That's your figure there. Good. So I'm happy you have finished this exercise. We have finished with long-term solvency and stability. What does those figures mean to you? What does it mean? Well, those figures that you have just computed there indicates to the firm the extent of debt financing relative to equity financing. So essentially what you're doing, those figures are really telling you what is the level of your distress costs, meaning is the firm in a position where it can continue to borrow, or has the firm maximized or maxed out its ability to borrow additional funds? What is the level of borrowing in the firm? And the third element of this, which is the interest cover, what it says is that whether the earnings from those borrowings, when you took those monies and you invested them into the business and the business generated profits, whether the earnings from those borrowings are sufficient to cover the cost of borrowing. And that's the interesting thing about this. Whether the money you're making in the business is sufficient to cover the cost of borrowing. All right, let's move on quickly. So let's go quickly to short-term solvency. I hope you're working with me now. We're coming to the end. Work with me. Short-term solvency and liquidity formula. So let's go first to the current ratio. So the current ratio, I want you to go to worksheet number 3 again. Worksheet number 3 again. And you are taking your current assets figure and you're dividing it over your current liabilities figure. So let's go quickly. On worksheet number 3, your current asset figure for 2001 is $209,940. 209,940. That's the current asset for 2001. And the current liabilities for 2001 is $160,817. 160,817. So when you divide those two figures, notice in this case, we are not multiplying by 100. We are not multiplying by 100 this time. So you're just dividing the two figures and leave it at that. I'll tell you what it means in a little while. Okay, you're not multiplying by 100. Let's go to 2002. In 2002, you're using your current asset figure is 216,608 divided by your current liabilities figure, which is $121,640. 121,640. So you're dividing those two figures and you're not multiplying by 100, okay? Good. Let's go quickly to our quick ratio. In the quick ratio, it's slightly different from the current ratio, and it's slightly different by one element. In the quick ratio, all you're simply doing is you're removing the inventory. That's all. So you're using the same current assets figure, and you're just removing the inventory figure. So let's go. We're still on worksheet number 3, right? So on worksheet number 3, under current assets, we have 209,940 minus 156,657. So the figure you're going to get there as your numerator would be, I'm doing it now, would be what? $53,283. So when you take inventory out of the current asset figure in 2001, you should end up with 53,283, and that's your numerator. And you will divide that over your current assets, which is 160,817. And you're not multiplying by 100, huh? Remember that. Good. Let's go quickly now to 2002. We're working out the quick ratio. So you're taking $216,608 minus the inventory figure. There is 159,144. And when you minus that, you're getting $57,464. And you're going, that's your numerator. And you're going to divide that over the current liabilities, which is 121,640. Excellent. So you all are very good students. We have completed that exercise. Well done. I know there are many who would have done this already. So what does these figures say to you? What does it mean, these figures? Well, these figures measure the ability of the firm to meet short-term financial obligations as and when they fall due. So if your current liabilities are more than your current assets, you're in trouble. Let me repeat. If your current liabilities are more than your current assets, then you're in some problems. You're going to have a working capital problem. You're going to have a liquidity problem. Always maintain your current assets must be greater than your current liabilities for you to have an element of working capital, for you to have an element of liquidity. All right? Good. Let's move quickly now to the last or the penultimate one, the one before the last. Let's go. Shareholders' return. Quickly, go with me. We want to do the return on equity. And I want you now to go to worksheet number 2. Under worksheet number 2, you're going to take your net profit after interest and tax. And that figure for 2001 is net profit after interest and tax would be $8,810. And you're dividing that figure over your shareholders' equity. And if you go with me to worksheet number 3, you'll see your shareholders' equity is a negative figure. So it will be $8,810 divided by negative 61,349. That's a figure, shareholders' equity. It's a negative figure. So you will get a negative outcome. All right? Let's go to number 2002. In 2002, your return on equity, you're looking at your net profit after interest and tax will be 78,516. 78,516. And that figure must be divided, if you go back to worksheet number 3, that figure will be divided over your shareholders' equity, which is 17,167. Notice you're not multiplying by 100 in this case, okay? Right. And then we go now to earnings per share. And earnings per share, we have, well, actually, you know what we'll do? We'll go back to return on equity, and we could multiply that one by 100. Yes, return on equity, will multiply that by 100. Let's go to earnings per share. This one, um, we're doing net, that NPAIT means net profit after interest and tax. Excuse me. Net profit after interest and tax divided by number of shares on issue. Excuse me. Essentially, what we're saying is, well, this one we will not be able to work out because, and let me tell you why. Well, you will see it for yourself. Go with me to worksheet number 7. And if you go to worksheet number 7 and you go down to note number 5, note number 5 says the state indicates the stated capital. And all we have is one share. So that computation we can't do today because we only have one share here. So let's move on to the next one. We can't do the next one either because we can't do earnings per share. So that will be the end of that. But the figure that we worked out for return on equity, what does that mean? Well, basically, it indicates the level of returns available to shareholders. So if you are a shareholder or an investor and you decide that you want to invest in a company or a business, you want to get a return. That's why you're investing in the first place. So whenever you invest, you get a return. So when you work out this ratio, it really indicates the level of returns available to shareholders. All right, let's move on to the final category. Final category of ratios. And I know many of you might be tired. So we're wrapping up. We're wrapping up now. So the final category of ratios looks at efficiency formulas or the efficiency ratios. And the first ratio I want you to calculate is your debtors days. All right? So I want you to work out for me your debtors days ratio. So let's go. You are going to worksheet number 3. And on worksheet number 3, you're going to take the accounts receivable figure there. That's your debtors. And under 2001, the figure is $50,595. And you're dividing that figure to your total sales, which is on worksheet number 2. And you're dividing that over 1,133,736. And whatever you get there, you multiply by 365, representing 365 days in a year. All right? So let's go again. I want you to go to worksheet number 3. The figure that is accounts receivable under 2001, you're taking 50,595 and you're dividing by the figure on worksheet number 2, which is your revenue for 2001, which is 1,133,736. And whatever you get there, you multiply by 365, representing 365 days in a year. Let's go quickly to creditors' days. Again, you go to worksheet number 3 and you go down to current liabilities and you'll see a figure called accounts payable and accrued liabilities. That figure under 2001 is $91,343. 91,343. You're dividing that over your total sales, your purchases. So you're going back to worksheet number 2 now. your total purchases, which is 794,101. So let's go again. Worksheet number 3, accounts payable and accrued liabilities, 91,343 for 2001. You're dividing that over your purchases figure for 2001, which is 794,101. And for 2002, the year 2002, you're going back to worksheet number 3 and you're picking up 82,053 and you're dividing that over on worksheet number 2, purchases 740,994. Whatever you get in those both years, you multiply by 365, representing the number of days in the year. And finally, the last ratio that we'll be working this evening. The last ratio I want you to work is what we call your inventory turnover. And under the inventory turnover, I want you to go to worksheet number 3, and I want you to take the inventory figure there under current assets. And in 2001, that figure is 156,657. 156,657. That's the figure for 2001. And I want you to divide that over your total cost of sales. And your total cost of sales in 2001 is 784,971. So let's go again. 2001, the inventory figure is 156,657 in 2001. And if you go back to worksheet number 2, your cost of sales figure will be 784,971. And whatever you get there, when you divide it, you multiply by 365. Let's go to 2002. You go back to worksheet number 3 and you look at inventory. Under 2002, the figure is 159,144. You're taking 159,144 and you're dividing by, on worksheet number 2, 740,114. 740,114. And whatever results you get there, you multiply it by 365, representing the number of days in the year. Good. Thank you very kindly for working with me on all of these ratios. Let's go and find out what those figures under this category means. The figures under this category measures how quickly customers are paying their accounts, or how quickly the company is collecting from its debtors, or how quickly stock is moved off the shelves of the entity. So, this information and these computations, these ratios are very important to inform decision making by management. Very, very important. Good. Right, so we have completed the computations part of this session, and we are now on to the interpretation part. How do you interpret? How do you interpret those figures that you have calculated there? Well, you can't be doing those computations in isolation. You can't be doing those ratio calculations in a vacuum. There must be a means to an end. So why are we doing it? Why do companies do ratio calculations from financial statements? Why? Well, it is really for the purpose of comparison. And when you look at comparison, there are two elements to this comparison. You can do comparison between two different companies in the same industry. So you work out the ratios for company A and you work out the ratios for company B, and you make a comparison between the two ratios. and you determine which company is doing better than which. Good. Or you can do another type of comparison where you look at a comparison between two periods of the same company, which is what we just did. We took one company and we compare 1 year and the next year, same company, two different periods. And that's what we just did. So comparison allows you to determine if things are getting better than, or whether things are better than or worse than. They're getting better or they're getting worse. Or whether things are improving or declining. That's the purpose of doing the ratio comparison. And based on the information that you have just worked out there, if you put it all now in a nice little summary, I'm asking you please to do a nice little table of all your ratios, year 1 and year 2, do the comparison and tell me what the results are. Are things improving or they're declining? Are things getting better or they're getting worse? Do a nice little table for me with all of your ratios. 2001, 2002, show me just the ratios and tell me if things are improving or declining. All right? Something like this. Do you have these answers? I know many of you are smiling from ear to ear because you would have worked out these answers and they're spot on. Your answers are spot on, eh? So, look at the answers. Just check your answers with me and tell me if you have these answers. Summary of the results. 2001, 2002, and the remarks. Gross profit margin percentage. What did you get? For 2001, you should have gotten 31%, and 2002, you should have gotten 33%. And the remarks that you would have written to your boss or your board of directors would be, things has improved. Your net profit margin, what did you get? In 2001, you should have gotten 1%. In 2002, you should have gotten 7%. And your remarks to management or to your board of directors should have been, things has improved by 6%. And then your return on total assets, you should have gotten 3% in 2001 and 28% in 2002. And what you would have said to your board or to your boss would have been, things have significantly improved by 27%, no, 25%, right? Your return on total assets have improved by 25%. What about your debt to equity ratio? Well, you had a negative 640% you ought to have gotten. And in 2002, your debts increased by 1,511%. So this company or this business is highly geared. That's what we will term it. It is heavily in debt. And then when you look at your debt ratio, 2001, it was 70%. In 2002, it was 60%. So the debt went down from 70% to 50%. It is better than the previous year, is what you would say. What about interest cover? Well, as we indicated, interest cover in year 1 would have been 0, and in year 2, your interest cover would have been 7.82, and we put times, not percentage. That's why I told you not to multiply by 100. What this essentially is saying is, you have made sufficient income to cover the cost of borrowing by 7.82 times. So you could cover your cost of borrowing almost 8 times. That is what that calculation means. So essentially it means sufficient to cover borrow costs. What about your current ratio? Well, in 2001, you should have gotten 1.3 to 1. And in 2002, 1.78 to 1. What do we mean by to 1? Well, what it really means is, and you notice we don't have any percentage next to this. What it really means is that your current assets can cover your current liability in 2001 by 1.3 times to every dollar of liability. And in 2002, your current assets could cover your current liabilities by 1.78 times to every dollar of liabilities. And we are saying here it is improving in its working capital. So, as we try and come to an end, your quick ratio, this is where you pull out the inventory. It will tell you that you could see that you are not able to cover your liabilities. In 2001, it was 0.33 to 1. So when you take out, why are we taking out inventory? Well, we're taking out the inventory because the inventory is very difficult to sell. And what you want is if your creditors come calling at short notice, you want to be able to see what you could put your hands on quickly to sell in order to meet your debt. What these ratios are telling us under the quick ratio is that we will not be able to put our hands on anything quick to sell to pay our creditors when they come calling when we pull out the inventory, because the inventory is the hardest thing to sell. So this business have to watch it. However, in 2002, things improved, and that's a good thing, but it didn't improve enough. All right? It must always be one and more. Right. Let's go now to return on equity. For your return on equity in 2001, you had a negative 14%. I know many of you would have gotten this and you're wondering, how could it be negative? Well, yes, it is negative, 14%. And in 2002, your return on equity was 457%. And that's pretty significant. And of course, we said that the earnings per share we were not able to. And then finally, your efficiency ratio, you should have gotten these. In 2001, your debtors days was 16.29 days. And in 2002, it was 14.20 days. What this means is that it is taking your business, in 2001, it took your business 16.29 days to collect its receivables, its outstanding monies. And it improved in 2002 because it took you 14.2 days to collect your monies. That's a good thing. You improved by 2 days in a year. Improvement in collections. Very good. And if you look at your creditors' days, for your creditors' days, meaning when you pay your creditors, when you pay the people you owe, you are taking, for in 2001, you took 41.98 days to pay your creditors. And in 2002, you improve a little bit. You took 40.42 days to pay. Now, this is not a bad position to be in, because if you look at this, look at something, watch this, watch it. Your debtors days. In 2001, you collected money earlier than when you pay out. You see that? And in 2002, you collected money earlier than when you paid out. That's a good thing. It means that you're very stingy with your payments. Very good. And you don't make joke when you want to collect your money. That's basically what it's saying here. And then finally, inventory turnover. In 2001, it took you 72.84 days to sell your goods on the shelf. And in 2002, it took you 78.48 days to sell the goods on the shelf. So which means that it got harder by 6 days for your goods to move off the shelf. Be careful with that if you're running this business. You need to reduce the number of days that your goods remain on the shelves. All right. Very good. Very good. Let's go now to make decisions. Working ratios by themselves does nothing for you. Ratios are not an end in themselves. They are a means to an end. When you look at your financial statements that we looked at earlier, the financial statements are there basically indicating to management and all stakeholders what has transpired, what has passed. And the purpose of working the ratio is to make decisions. So, following the calculations and interpretations of ratios, decisions, and you see I have in bold, decisions must be made. So, working the ratios and leaving them there don't make any sense. You work the ratios and you make decisions after. One, if the results are declining, the question you must ask yourself as a business is, what can we do to improve? Two, if the results are improving, the question you must ask yourself is, what can we do to sustain our current efforts and improve even more? And number three, if the results remain constant or stagnant, the question you must ask yourself is, why are we not growing? And these are serious questions for any business. And as you learn finance and understanding financial statements and how to interpret those financial statements, these are very important questions that you must ask yourself when making decisions. So, after asking these questions, you must take action. What are the actions to be taken? Well, one of the first things businesses do when those results come forward and the reality hits them. Question number one, what changes can be made? So, what businesses do is the change from the top. Changes to be made at the top. So, you either change your management team, you change your senior executive team, or you change your board of directors. That's one action that can be taken. Another action that can be taken is business process reengineering. What do we mean by this? Well, with business process reengineering, it is what we call your new growth strategy needed to evoke change. So basically, what we're looking at here is you look at the business from all angles and you determine where you can make adjustments. So it's called business process reengineering, looking at reengineering the business for to create growth. Number three, what action you could take? You look at assessments and amendments to be made to the firm's critical success factors. What do I mean by that? Well, you have to sit and seriously consider whether those factors that makes you successful needs tweaking. So, do we need to adjust the ingredients in the products that we are making? Why are we not selling more? Do we need to change packaging? Do we need to add a new product line? Do we need to remove a product line? These are significant questions that are required at the business level and the corporate level, and businesses make these decisions every day. I wonder if you all have you all recently noted Bermudez? Bermudez is one of those companies who engage in this regularly. Business process reengineering, reassessment, realignment. Bermudez does this regularly. Recently, Bermudez came out with a new Dixie, a wheat Dixie. And that wheat Dixie is loved by all now. So people are giving up on the white flowered Dixie cracker and they're going to the wheat Dixie cracker. But one of the problems with this strategy is businesses must be careful that while they would want to add new product lines and so, that the new product lines are not cannibalizing the existing product lines. So they may end up into some problems. So what is required is a balancing act. And finally, action number 4 is what we call a paradigm shift needed to reposition the organization. Action is required. All right? A paradigm shift is where you look at the culture of the organization and you look to change the culture. You may require removing or retrenching staff and sending people home and bringing in new staff, or you need a new name change. You need to reorganize the company. You need to look at a different direction, a new business model. So a paradigm shift is required, is where you're making significant changes to the organization as a whole. Finally, we look at notes to the financial statements. And as you could have seen, there were some elements in the financial statements that we were working with that it would have been difficult for us to understand had we not gone to the notes. And so the notes were very helpful in helping us to understand some of the information in the income statement, balance sheet, and cash flows, right? So the notes to the accounts sheds new light on dark areas in the financial statement so that users can be informed of significant accounting issues within the statement. Um, the notes can go into more details here than on the face of the statement where it may not be possible to do so. Those notes contains more critical details than you would have gotten from the financial statements, which are summarized. The notes contain concerns which the auditors or the accountants may have in the preparation of the financial statements. And finally, notes makes for interesting reading beyond the niceties of what is presented within the financial statements. Notes are very important. Right. So we have come to the end. So I have included here for your benefit a nice um, uh, video that I want you now to just sit back, relax, turn up the volume on your system, make sure you have a speaker so that you can listen to this 1 minute. It's a financial statement explained in 1 minute. So just take this in for me, 1 minute. To determine whether you should, for example, invest in a company or buy its corporate bonds, you can analyze its financial statements. There are three important financial statements which complement the company. One, the balance sheet, which is kind of like a photo of the company at a certain point in time. It tells you at that point in time what assets, such as cash in the bank, inventory, or real estate, and what liabilities, such as, for example, debt to supply. Subtract the liabilities from the assets, and you'll have the net worth of the company at that, also called the income statement, also called the profit and loss statement, does exactly what its name suggests. It gives you a summary of the revenue and expenses generated by a company over the reported period. 3. The cash flow statement also has an intuitive name and tells us how much cash and cash equivalents entered and left to come for the period. If, for example, the management reports considerably higher profit, but there hasn't been that flow income, as a short recap, the balance sheet helps you determine the net worth of the company. The income statement shows you how profitable it is, and the cash flow statements tells you things such as whether or not the profit numbers are believable. Okay, so we have come to the end of our presentation. It is now 10 minutes after 7. We are well within time. We are supposed to end at 7:30. So at this time, I am going to hand the session back over to the Cipriani Labor College, to Mr. Colin Bartholomew. who is going to assist in this part of the session. So I hand you over now to Mr. Bartholomew, who is going to do just that. So we are taking questions at this time. If there are any question, right? So we are taking questions at this time. If there are any questions, we have Colin Bartholomew from Cipriani Liberal College here is going to assist us with the questions, and I will provide the answers. So you're now free to submit. Colin, can you come in?
Yes, good afternoon. Hear me?
Yes, yes, Colin, I'm hearing you
Yes,
loud and
good,
clear.
good. Excellent. Thank you for that very informative, insightful, and very lively presentation. I have looked on the chat and I haven't seen anyone ask any questions in particular. I really found the video at the end was very interesting. However, I know some persons indicated they were not hearing as clearly as they should. So I guess before we go out this evening, I can um I can
Yes,
probably run that video again just to
but I
re-emphasize and
right.
solidify what was done.
Right. Okay. So
Yes.
Colin, what we can do, we can run back the video, but I don't know if there's anything on your side
Mm-hmm.
where where we can adjust the volume, but the volume is pretty loud on my side.
Yes, yes, yes.
Were you hearing the video, Colin?
I was really barely hearing it. I know on this platform, the best solution is to have the external speakers along
Right.
with the
Yes.
presentation.
Because
Yeah.
I have external speakers. That's
Okay.
why I'm hearing it
Okay.
clearly. Yes.
Nicely.
Okay, so if they don't have external speakers, we can always forward the presentation to them,
Yes.
Colin, and they
Yes.
would be able to hear. It's just a 1 minute video, and they'll be able
Video.
to hear it. Yes.
Excellent. Excellent. I
Yes.
was really engrossed in the presentation. I was particularly intrigued by the
Well,
fact that you had them working feverishly on those
right,
calculations. And I hope based on that, we could really see some improvement in terms of reporting to management and boards.
excellent,
Yeah.
excellent, excellent, very good. All right. So if there are no questions, Colin,
Hmm.
if there are no questions, at this stage, we want to thank everyone, all the participants for attending and for being part of this session today. At this time, I want to recognize Director and the Vice President of SFCCU Credit Union, Director Marcia Goodrich Constantine, who is not feeling well at the moment, but she would have been instrumental and responsible for putting together this segment. And um, I want to thank her for inviting me to be a part of this session. And therefore, we want to wish her a speedy recovery. Also, we want to thank the Cipriani College of Labor and Cooperative Studies and by extension, Mr. Colin Bartholomew. I want to thank you very kindly, you and the college, for using your facilities to facilitate these sessions of the SFCCU Credit Union Education Committee. To the members of the Education Committee who may be present with us, we want to thank them for attending. We want to congratulate you guys on putting together an excellent um, schedule of activities for the 2020-2021 term. And I really wish you all success going forward with all the other programs that are to come. Colin, I don't know if you want to mention for the participants the programs that are carded to proceed this one.
Yes, thank you very much. So there are a number of upcoming presentations along this vein. In the past, you would have looked at understanding the philosophy of the credit unions, and today we were really fortunate to receive this presentation on understanding the financial statement. And this has given me some time to actually pull up the document. And I know as we go along, there will be a presentation by Quina in terms of wills and rebates. Further to that, we will also be receiving a presentation on understanding this very platform which will explain the Google Meet, the YouTube, and various streaming platforms which we can utilize, but to get to specific dates. And I have the document here now. Right, coming up next, and it's actually carded for next week. All right, we will be looking at wills and probates, and that's scheduled for the 11th of
Yeah,
February.
Colin, that sounds have like a very interesting
Very interesting.
yes one. Yeah.
It's always very speculative when it comes to wills and probating wills and letters
Yes.
of administration, and particularly within the credit union movement, as it relates to persons having a firm grasp and understanding of what needs to be done. So I think it's very instructive that you enroll, you register, you share, and you invite as many people as possible from
Yes.
the membership, from friends, from family to be a part of that discussion. And that's next week,
Yes.
Thursday at
Excellent.
5:30. And the
Excellent.
following week at
Mhm.
on the 18th of
Mhm.
February, what is carded is understanding industrial relations and recognized majority unions,
Brilliant. That
known as
also,
RMUs.
yes,
Yes,
Colin, that also seems very, that is something too, I think a lot of people would be interested in
of
because it's
course.
important to understand industrial relations and what is required with employees and so.
Yes, yes, very true. So we look forward to sharing that information through this SFCCU online education series. And as you would have received the email invitation, there is a registration link. So we encourage you to register to be able to be placed on the platform and receive the link to join the session, as well as share as far as wide as possible. So we really happy to partner with the SFCCU Credit Union through this initiative of the Education Committee.
Yes.
And we joined by I could call him my friend because we have known each other for
Certainly,
some time.
certainly, certainly.
Yes, Mr. Garner Jessup,
Yes, sir.
who delivered so eloquently and really knowledgeably the, on his area. And, we happy to be a part of the quality of
Thank you
this
very much, sir.
production and this presentation. So we look forward to that. And of course, being on this platform, the Cipriani College of Labor and Cooperative Studies will also share with you our offerings. But right now, we're focusing on the education series of SFCCU and this partnership between the credit union and the Cipriani College of Labor and Cooperative
Excellent.
Studies. So
Excellent.
that's that's it from my end, Mr. Jessup,
Well,
Pleasure.
Colin, I want to thank you again and thank the college. And I don't know if the secretary of the committee who is in this workshop, I don't know if there's anything she would want us to translate to the participants. Um, I don't know, but I'm not seeing anything to that effect. So I think this is where, Colin, we call it a quits. And
Yes,
we want to thank everyone for attending the session today, and may God bless you. Thank you
yes,
very
God
kindly,
bless.
Colin. I hand it over to you.
Yes, so we'll bid each and everyone in this meeting farewell God bless, and please keep safe and practice that responsibility that will keep others safe as well at this time. So thank you very much.